The cash market is locked. We are exactly 15 minutes past the closing bell, and the scoreboard is just a complete mirage today. S&P 500 down just 0.19% to 7,443.28. NASDAQ slipping a fractional 0.055% to 255508.07. And the Dow taking the actual hit, dropping 0.59% to 51839.26.
Right. I mean, it looks like total chop, just a sleepy summer session if you only glance at the top-line indices. But the narrative beneath the surface is a massive head fake. The real money is aggressively repositioning right now.
Yeah, the volume confirmation just wasn't there today. We traded well below the 30-day average. But the real structural risk here is how this tape completely ignored active geopolitics. We had U.S. and Iran airstrikes over the weekend.
Exactly, and textbook macro theory says you get a massive flight to safety Monday morning, right? Equities dump, yields spike, oil flies.
And we did see crude spike initially. West Texas Intermediate surged almost 3% right at the open. Plus, the 10-year Treasury yield actually climbed to 4.56% today.
Which is a heavy, heavy headwind for equities.
It is. But then, look at the closing print on the VIX. The volatility index actually dropped over 7% to 17.42. I mean, bond yields are climbing, missiles are literally flying, and the fear gauge collapses. That doesn't make sense.
Well, it makes perfect mechanical sense if you understand the options market. What you're seeing is a classic volatility crush.
Okay, walk me through the execution on that.
So put yourself in the seat of an institutional PM on Sunday night. News of the airstrikes hits, you have massive equity exposure, but the cash market is closed. You can't liquidate. So what do?
You rush to the futures and buy short-term puts.
Right, you buy fire insurance. Everyone rushes the exact same door simultaneously, so implied volatility absolutely skyrockets. But then midday today, we get those headlines about a potential 10-day ceasefire proposal.
Ah, so the tail risk just evaporates.
Exactly. The algos immediately reprice the probability of a global supply shock, and suddenly it's just a contained regional issue. So all those managers violently unwind their hedges, they dump the insurance.
And they faded that WTI rally right into the close. Oil only finished up 0.9%, settling at 82.49 a barrel. Brent closed at 89.22. They basically canceled the panic.
They canceled it because they are paralyzed by something else. The real focus is entirely on the Q2 earnings gauntlet this week. Nobody wants to hold directional risk with Charles Schwab reporting Tuesday and then the mega caps, Alphabet and Tesla, on Wednesday.
Yeah, let's talk about the mega caps because we saw some violent key reversals today. Apple hit a record all-time high on Friday, closing at 333.74. Today it opened strong and then just cratered. It was the worst performer in the Dow, closing down 2.87% at 324.18.
It's textbook buy the rumor, sell the fact execution.
But the print isn't even out yet.
Right, but institutions rode that momentum to the absolute top on Friday. Now they're looking at their unrealized gains, looking at late July earnings, and they are de-risking. They're locking in the profits because the career risk of holding a top-heavy stock through a potential guidance miss is just too high.
And it wasn't just Apple. Tesla had fantastic pre-market catalysts, right? Rumors of Starlink integration. Chatter about a 20% capacity bump at the Berlin Gigafactory.
Which is pure retail bait.
Completely. The stock caught pre-market bids and then violently reversed, closing down 3%. If the news was good, why did the real money fade it so aggressively?
Because if you look at the institutional models, nobody cares about delivery volumes or factory capacity right now. The only metric that matters for Tesla on Wednesday is auto margins.
Right, because of all the price cuts.
Exactly. It doesn't matter if Berlin produces 20% more cars if the profit per vehicle is compressing. So institutions use that morning liquidity spike driven by the Starlink headlines to just quietly unload their bags onto retail. They are building dry powder.
They did bid up Intel, though. Intel jumped 3.9% to 98.74.
Yeah, well, that was an expanded Google Cloud AI partnership. Alphabet rose 3.34% on that, too. But honestly, it was just targeted stabilization for the chips after last week's bleeding.
So if big tech is just a mixed bag of profit-taking and targeted stabilization, what is actually happening underneath? Because if you look beneath the surface, the breadth today was just horrific.
It's the real story of the session. The S&P 500 cap-weighted index is totally masking the rot.
I mean, let's look at the internals. 8 of the 11 primary S&P sectors closed red. Healthcare down 1.15%. Materials dropping 0.94%. The only real strength was communication services up 0.74 and energy up 0.55.
And look at the advanced decline line.
It's a bloodbath. The daily AD ratio came in at a dismal 0.8. Total market advance was just 44%, NYSE at 53%. But the NASDAQ, only 39% of stocks advanced today.
So for every 2 tech stocks going up, 3 are actively bleeding. That is a massive structural divergence. You look at the S&P 500 equal weight index, it was under heavy pressure. The Russell 2000 dropped 0.7%.
Because of that 10-year yield we mentioned.
Yeah, exactly. A 4.56% 10-year chokes the life out of small caps. They rely on floating rate debt. They don't have Apple's cash pile. So you have this severe concentration risk right now. The headline indices are propped up by a handful of AI-adjacent names, while the broader economy is suffocating under the cost of capital.
Which brings us to the technical setup for tomorrow's open. The volume confirmation isn't there, the breadth is weak, and the SPY closed right at 742.50.
Which puts us literally sitting on top of a massive gamma wall.
Right. The data shows the options floor is right at SPX 7420, so SPY 742.
That 7420 level is the absolute line in the sand for tomorrow. Market makers have massive concentrated options exposure there. If price breaks below 7420, their models flip, and they are mathematically forced to aggressively short the index to remain delta neutral.
That's the trapdoor.
That is the trapdoor. If we break 7420 on heavy volume, there is zero structural support until the 50-day EMA down at 7358.
Wow, okay. But overhead resistance is sitting close too, right? SPX 7450.
Yeah, so the continuation probability for a massive directional move tomorrow is mathematically under 35%. The asymmetric trade here for institutions is just to fade the extremes. Sell 7450, buy the bounce off 7420. They're just going to play ping pong and collect premiums until Alphabet and Tesla print on Wednesday.
Right, but there is always a trade blinking at the post-market earnings for some high-conviction Day 2 plays.
Day 2 setups are where the actual clean institutional accumulation happens. What are you seeing?
2 names. First, Zions Bank Corporation, ticker ZION. Massive beat. They posted EPS of $3.05.
Wait, didn't they have a one-time Visa sale in there?
They did, yeah, $215 million share sale. But even if you completely strip that out, core EPS was still 1.74, and the street was only looking for 1.57. Plus, tangible book value surged 22% to 44.74, and they announced a fresh $225 million buyback.
Okay, that's real strength for a regional bank in this rate environment.
Exactly. So the technical setup is to watch for a high-volume breakout past Monday's high of 72.52. If it clears that, it has room to run.
Nice. What's the second one?
Crown Holdings, ticker CCK, Global Consumer Packaging, beverage cans.
Ah, a defensive rotation.
Totally defensive. Flawless Q2 beat and raise. Adjusted EPS up 16% year over year to 2.49. Beverage can volumes rose 5% globally, and management bumped full-year guidance to an 8.3 to 8.50 range.
See, that is exactly where smart money hides. You get a high-quality, non-cyclical business raising cash flow guidance while everyone else is panicking about tech margins. It doesn't matter what yields do, people are still buying drinks.
Right. So you have institutions fading geopolitics, hoarding cash, hiding in beverage cans, and leaning on gamma walls to keep the S&P flat. It is a treacherous tape to navigate.
It really is, and I think the ultimate risk you have to weigh right now goes back to those mega caps. The market is forgiving these macro shocks solely because of the AI infrastructure narrative. It's the only pillar holding up the broader indices.
So if Tesla and Alphabet hint that AI capex is slowing down,
then the whole thing breaks. If that spending isn't translating to near-term cash flow, and the massive tech spending cycle has peaked, you have to ask yourself, are we actually pricing in a technological revolution right now, or is this just a multi-trillion-dollar mirage?
that is the structural risk for Wednesday. Watch that 7420 gamma wall tomorrow at the open, manage your downside, and respect the closing prints. We'll see you back here for the next deep dive.